One of the other questions that I often get is, what about inflation? I mean, in the last 90 days alone, the Fed has pumped an unprecedented amount of money into the money supply. So many are concerned about the prospect of inflation. Traditionally, inflation moves with wage growth and commodity prices. Now, wage growth is well contained. Now, if you're not certain of that and you want to test it, on Monday morning, please call up Henry and ask him for a raise. And I think you'll see that wage growth is pretty well contained. Now, oil closed below $70 a barrel yesterday, so this is helping to moderate any inflation concerns as well. The money being pumped into the credit system is not being loaned back out. Banks are afraid of the counterparty risk. They're afraid to loan to one another. So until confidence comes back in the market and our banks start to loan to one another again, I think we've got this inflation thing pretty well contained. And even once banks start loaning to one another again, I think what you'll see is the U.S. Treasury come in and issue more Treasury notes to soak up any excess cash that's in the system. So the big question, the Dow Jones has fallen tremendously since October 2007. I think yesterday alone we lost about 700 points in the Dow Jones index. The S&P 500 is down over 40% since last year. The Dow Jones is down around 35% year to date this year. We've lost around $2 trillion in market value over the last year. So I'm certain that all of you have noticed that your 401k statements are a little more thin than normal. So everybody wants to know what's contributing to the sell-off. Well, there's a combination of forces that are really working in the market right now. You have certain companies that used to access the commercial paper market in order to fund their operations. Well, the commercial paper markets are frozen, which means companies cannot get access to short-term loans. That is going to hurt their earnings. They're not going to be able to grow as fast. Investors recognize this, and they're obviously selling the shares of those companies. Hedge funds that took on a lot of leverage during the boom years when credit was easy, now they are also being forced to sell assets to meet margin calls, shore up cash, and they're also trying to meet debts or maturing debts that they can't roll over because the credit market is frozen. So they're selling assets, which means they're selling the shares of these companies in the marketplace. In addition, if you listen to a lot of the news channels, you may hear something that they call capitulation. A lot of people are talking about capitulation. And capitulation is when investors basically just throw their hands up and force sell assets because they just can't take it any longer. And a lot of that is happening in the marketplace right now, mainly from retail investors. So that's guys like you and I. We're watching the markets dwindle. We're watching our retirement accounts evaporate. We're watching our college accounts just tighten. And we're just saying we cannot take it any longer. And we're redeeming our shares in our mutual fund accounts. And the portfolio managers of those mutual fund accounts, they then have to force sell shares in order to meet their redemptions. So there's a lot of downward pressure in the marketplace right now. So what should you expect going forward? You know, 5 of the 15 largest commercial mortgage-backed security loan contributors have been eliminated from the marketplace. They contribute $46.5 billion in commercial real estate loans in 2007. So less participants in the loan market leads to inefficiencies and downward pressure on permanent loan originations. This is very important for you guys because you guys are typically working with developers that are doing construction deals. Well, one of the things the banks had started doing is as they made these construction loans, they would model on how they could get these loans off the balance sheet and into the permanent loan markets. Well, the banks start to realize that they can't get loans out into the permanent loan market because the credit system's frozen. There's going to be a drawback in construction loans, and we're obviously witnessing that right now. A lot of projects are no longer making it. That does not mean every project is not making it. I'll tell you a quick story. I was working on a deal here in High Point, and it was a group of investors that wanted to buy some apartments. And they ended up not buying these apartments, and they told the seller of the apartments that they couldn't get a loan. But that was completely untrue. They actually could get a loan. They couldn't get a loan at 90% loan to value. They couldn't get a loan with interest only. They couldn't get the loan that they wanted, that they were used to, but they could get a loan. They were going to have to come up with more equity. They were going to have to bring in a professional management company, but they could get a loan. So what's happening right now is investors are saying they can't get financing, but what that really means is they can't get financing the traditional way, or not the traditional way, or the way they were used to getting it when credit was pretty easy. So right now, commercial mortgage-backed originations are around $18 billion this year alone. This is significantly down from the $188 billion that we had originated this time last year. So we've only originated $18 billion compared to $188 billion the same time last year. That's a massive drop-off. The nationalization of Fannie and Freddie have improved the borrowing costs of these agencies. So we have seen mortgage rates on residential property come down to around 5.8% from 6.25%. Now, lower rates combined with home values that have depressed. I mean, home values are down about 15% nationally. And personally, I believe that we're going to see home values decline another 10% before this is all said and done. This is helping housing affordability. And obviously, lower rates are helping some people return to the marketplace. Now, growth in commercial real estate will continue to slow dramatically, and that's mainly because of some of the things we've talked about with the permanent loan market, with the exception of the apartment projects. I think apartments still are well positioned to continue to grow. We do see rents increasing and vacancies are dropping in apartments right now. Obviously, if you didn't buy a house in the last few years, you probably won't be buying one in the coming years. So people still need a place to stay. So Fannie Mae, Freddie Mac, and HUD have all stepped up in a major way to keep apartment deals going. So we see a lot of developers trying to concentrate in that area. Retailers and companies are no longer expanding. That's going to put a lot of downward pressure on shopping centers and office buildings. Industrial properties in select markets are still expanding. I think obviously the industrial market here in our local region, in the Triad region, is still doing very well. So depending on what market you're actually operating out of, industrial is still doing well. Now hospitality, on the other hand, is under extreme pressure. Travel is down, not as many people are traveling, and there's just a tighter credit market which is boxing out a lot of our hospitality developers. So right now we see a lot of the strength mainly in the apartment segment. As I get ready to conclude here, or get ready to take a couple of your questions, I just want to touch on a few different points here. You know, I hear a lot of people when I go out and I speak to companies like this, they ask me about depression. The D word always comes up. And I'll be very honest with you. I mean, I've studied a lot of the depression. I've studied a lot of the trends that occurred in the 30s. The trends that are emerging in our market right now are identical to what we saw back then. They are identical to the same trends that emerged in the credit market back in the 30s. But this is the fundamental difference. We're managing it much better. We're just managing it much better. Our responses to it have been much better. Think about it. Our communication and our technology is tremendously better. Back then in the 30s, if a company failed or if they were under pressure, you may not know about it for 2 or 3 weeks. If a company failed this morning, we all know about it. We know about it by 12 o'clock. We communicate much faster than we did back then, so that's obviously helping us to respond to the challenge much better. Back then, they tightened credit. They didn't put any liquidity into the credit markets. As you can see, as I mentioned earlier, the Feds have come up with a variety of ways to keep injecting liquidity into the credit markets, and they are very serious about keeping money in the credit markets. This should help us not see the deep recession that we saw back in the 30s. The other main difference is back in the 30s, a lot of countries turned on one another. They started raising tariffs on each other. They tried to go into a protectionist state. And we're not doing that right now. Right now what we see is a lot of countries are actually trying to work together to solve this problem. The reality of it is we're in a globalized community. You hear that all the time. We are interdependent with all the countries that are around us. If we catch a cold in America, they sneeze in China. That's the bottom line. So a lot of countries are definitely working together. So I think that's going to help us keep away from the deep depression that we saw back in the 30s.